All right, so first, as I mentioned in my email and on the syllabus actually, so from now on class starts at 9. So we basically we'll shorten the break so that the class can start later. So last week we were talking about the equity premium puzzle. So the observation is that the return of stock in the long run is quite high relative to bonds. So the blue line is real stock return, is real stock index. The pink line is real government bond index. So basically you can see that over the long run, stock return gives you a much higher return than bonds. Another way of looking at this is looking at cumulative returns over a 20-year investment period. And basically, no matter when you start investing, a 20-year return is always positive in the past. So the puzzle is, despite the fact that investing for the long run almost always give you positive return, a lot of people do not hold any stock. So this would be puzzling because most people have to save for retirement. In Hong Kong in particular, you have the MPF. You're forced to save for retirement. You can't use the money in any way, not even in emergency. So I'm not sure whether there's limited exception for the emergency. But generally, you can't use the money. So if the money you're going to put in is going to last for decades before you can use it, there's very little reason not to invest them in stocks. And then we talked about the CARA model last week, and skipping the math, basically what you get is the money investor put in stocks should equal the excess return over the measure of risk aversion times variance. Now this is a very simple model. Might not be too realistic in some of its properties, but with this we can illustrate why the equity premium puzzle is a problem, because any realistic return, say an excess return of stock over bonds of 7%. So on average, stock earns 7% more than bonds, with a standard deviation of 15%. So it sounds quite risky if you just look at the numbers. Still, you assume that the typical U.S. investors have 30% of their wealth in stock, which is higher than reality, and you get an estimate of their risk aversion to be 10, which is extremely high, as we talked about last week. Basically, someone with a version of 10 would not take the chance of earning infinite wealth with 99% chance over a 50% sure gain of wealth. So no money can induce this investor to give up a 50% chance of earning, the chance of for giving up sure chance of earning 50% of her wealth, right? So she's very risk averse. Even if you give her all the money in the world, she's still going to say, nope, I'm going to just take 50%. I'm just going to take 50% more of my wealth, and I want absolutely no risk. So that's a problem. And so we skip the math. So this is the equity premium puzzle, and you can either say that their risk aversion is too high, or you can say the observed investment amount is too small. So depending on your view, you have different directions of investigating why this is happening, and different reasons. But what we want to focus on is this diagram, which is yearly excess return. So this is the yearly difference between stock and bond return. The previous diagram was 20-year difference. So aggregated 20-year difference. This is a single year difference. Now, aggregate difference are always positive. So it's always in favor of stock. But annual return is not. So in any given year, you can see that stock only outperform bond slightly more than half the time if you look at a single year. For example, this year, stocks are doing extremely poorly. So if you buy stock this year, bad for you. Actually, even if you buy stock in these few days, it was quite bad. So for this reason, if people have this diagram, this distribution in mind, instead of the 20-year accumulated distribution, then the stock market looks very risky. Intuitively, if you just have this diagram, it's kind of difficult mentally to accumulate the return over time. So you would just think, oh, the stock market has a half chance of losing money for me. So I probably don't want to put that much money in it. Despite the fact that if you think carefully, over time, the gains offset the losses. So now last time, we talked about for this to truly have a very strong effect, what you need is that people really hate losses. So having a gain of equal size as a previous loss is not, they do not cancel out each other. Having a gain right after a loss, you still feel a loss because you really hate losing money. So a half chance of gaining and losing does not feel like even. If a half chance of losing feels a lot more painful than than the happiness you get from a half chance of gain. That's called loss aversion. People do not like losing money. And so making a loss is more painful than not making equivalent gain. Okay. We also say that people are short-sighted. So this is needed because if they are completely rational, they would not be looking at the yearly distribution. They should be looking at the 20-year distribution for their retirement. So they need to be short-sighted to be able to look at just a yearly distribution. So this is called myopic loss aversion. And myopic refers to short-sightedness, and loss averse refer to the hate loss. Now so stock is very risky because they're looking at short-term distribution and they hate losing money. Now last week we talked about the properties of the loss aversion model. First, you hate losing money about 2 times more than you like gain. So that's loss aversion. Through the series of questions we did last week, you see that in general, people are risk averse in the gain domain. When you earn money, you become risk averse. When you lose money, you become risk seeking, as we see in the first set of questions last week. Second, people have probability weighting. That is, people don't really behave according to the objective effect of small probabilities. When you tell them there is a very small chance that something bad happens, like 0.001% chance, they would act like it's like 5%. The good example, as I mentioned last week, is the effect of the radiation in Japan. Virtually, there's no negative effect if you are going to a place like Kyoto. So far, it's far away enough that there shouldn't be any effect. Still, people avoid going to even those places in Japan. So that's behavior which says that people don't behave according to the objective probabilities, right? And there is an exception, is that people behave very strongly to sure, the 100%. Sure thing is different from 99.9%. Sure is sure, and people react very strongly to a sure probability versus a certain probability. Okay, so people hate losing money more than they like gaining money. Or actually, people hate losing things more than they like gaining things. They are risk averse when they gain, and risk seeking when they loses. And finally, they reweight probabilities. They don't behave according to objective probabilities. Together, it's called a prospect theory. Now, this is the simple explanation why prospect theory, in particular loss aversion, the hate of loss, can explain the equity risk premium. So I'm first going to talk about how the model works with an example, very similar to the model is framed after the experiment we talked about last week, the one where you exchange mugs for candy. Then we're going to go back to the evidence, experimental evidence, which shows that if you have a simulated stock market, instead of observing existing investment patterns, right? This is just observing what people do. It's not very strong evidence that loss aversion is the reason. It's just loss aversion loss aversion can explain this behavior, this observation, but the observation itself is not evidence supporting myopic loss aversion because there are other possible reasons too. So what we're going to see is that economists have run experiments, basically having students sitting in a computer lab playing simulated stock markets and see whether you can manipulate them in ways that show that loss aversion is in fact the reason. Okay, so let's first go to the math